This is not financial advice, and I am not a financial advisor.
This is just me talking about my personal financial journey. This is for entertainment purposes only.
Enjoy the show!
Looking over the notes you sent in to us, you've really handed us like the ultimate real-world case study for what is arguably the wildest day in modern market history.
Oh, absolutely. It's unprecedented.
Welcome to this deep dive. Today is Friday, June 12, 2026, and we are unpacking a stack of sources today. We've got articles on market liquidity, the official S1 prospectus, some research reports on tech mega mergers, and most importantly, your personal portfolio breakdown.
Right, because today is the day.
Today is the day. SpaceX has officially gone public on the NASDAQ under the ticker SPCX, but it hasn't just arrived as, a rocket manufacturer. It is debuted as a staggeringly massive multi-trillion-dollar mega merger with xAI.
Which is just a massive fundamental shift in how we categorize these companies.
Yeah, and our mission today is to analyze the aggressive portfolio pivot that you, the listener, made this morning to capitalize on this debut. We're going to break down the mechanics of the market, the underlying technology, and really the intense psychological pull of a day one IPO.
Because when we look at the sheer scale of the SPCX prospectus, we aren't just looking at the privatization of space exploration. I mean, we're looking at a fundamentally new classification of a mega cap asset that operates on this closed loop infrastructure.
Right.
We have never seen a single entity attempt to own both the global hardware layer and the absolute frontier of the software layer simultaneously.
Okay, let's actually unpack that.
Yeah.
Because calling it a mega merger really doesn't do justice to why the valuation is literally in the trillions.
No, it doesn't.
Historically, SpaceX built the physical infrastructure of the future, right? You've got the Starlink satellite constellation covering the globe, beaming internet down to remote areas.
Yeah.
You've got reusable heavy lift rockets driving down the cost of payload delivery.
It's strictly the physical layer.
But then xAI enters the equation. And xAI isn't just like functioning as a chatbot on a server farm somewhere. In this combined entity, it's theoretically processing the real-time data from that physical infrastructure.
Yeah, think about the data routing required for, tens of thousands of satellites utilizing optical laser links in low Earth orbit.
Which is just a massive amount of data.
Incredible amounts. And the latency requirements are microscopic. So by integrating xAI directly into Starlink's operational matrix, the artificial intelligence is optimizing global packet routing autonomously.
Wow.
Right? It is predicting network bottlenecks over the Atlantic before they even happen and shifting bandwidth dynamically. That kind of low-latency global communication network becomes the ultimate nervous system for everything from high-frequency trading to autonomous global shipping logistics.
So it's basically the brain for the entire planet's infrastructure.
Precisely. The market is pricing in an AI superpower that doesn't have to rent its data infrastructure from traditional telecom companies or cloud providers. It owns the entire stack, from the server rack all the way up to the stratosphere.
Which totally shifts how capital behaves today. I mean, I was looking at the trading volume across the broader market this morning, and it's acting like a massive sponge dropped into a small bucket of water.
That is a very good analogy.
Right. If you drop a multi-trillion-dollar sponge into the NASDAQ, it physically has to absorb liquidity from everywhere else. Institutional managers are forcibly rebalancing entire sector funds just to free up cash to get an allocation of SPCX.
Yep.
And looking at your portfolio notes, you did the exact same thing on a retail level. You completely liquidated established positions just to get pulled into that sponge.
And we really need to look closely at the mechanics of what you actually sold to fund this.
Oh, absolutely. Because you decided today was the day to clean house. Looking at your trades, you completely sold off your entire positions in two specific stocks: Replimune, ticker REPL, and BigBear.ai, ticker BBAI.
Both gone entirely.
Right. You liquidated both of these holdings entirely, took the cash, and fully reallocated those funds into buying the SpaceX public debut on the open market today.
Which is a huge move.
It is.
Yeah.
And actually, before we go any further, it's just to be incredibly clear to everyone listening, we are dissecting your move as an analytical case study of market psychology and portfolio strategy. This is absolutely not financial advice for anyone to blindly copy.
Yes. Please, let's heavily emphasize that. We are not recommending that anyone liquidate their assets to chase an IPO. Do not copy this. This is just an analysis of what one specific listener chose to do with their own portfolio.
Exactly. Not financial advice.
Yeah.
But, I mean, from a purely strategic standpoint, dumping two established, albeit smaller, tech and biotech stocks for a day one IPO is a massive leap of faith.
It fundamentally rewires the risk profile of your portfolio. I mean, let's actually look at the mechanics of the companies you abandoned. You dropped Replimune, which operates in the micro to mid-cap biotech space.
All right.
And they don't just make generic pharmaceuticals, they specialize in oncolytic immunotherapies. The underlying mechanism there is fascinating. They actually engineer strains of the herpes simplex virus to selectively replicate only inside cancer cells.
Wait, so they're using a herpes virus to fight cancer?
Yes, exactly. Because normal, healthy cells have defense mechanisms that stop the virus from replicating. But tumor cells, they've mutated to turn those defenses off so they can grow faster.
Oh, wow. That's incredibly clever.
It really is. So the virus replicates inside the tumor cell until the cell literally bursts a process called lysis. And when it bursts, it releases tumor antigens into the bloodstream, which is essentially waving a massive red flag to wake up the patient's own immune system to attack the rest of the cancer.
That is brilliant cutting-edge science.
It is. But biotech stocks trade entirely on the mechanics of FDA clinical trials. It's a grueling, decade-long waiting game of cash burn. A phase 2 clinical trial data readout can send a biotech stock up like 200% in a day.
Or wipe out 80% of its market cap overnight if the efficacy isn't there.
Exactly. It's incredibly volatile.
And then you paired that sale with BigBear.ai, which is a much smaller AI play, heavily focused on predictive analytics for defense and manufacturing supply chains.
Right. A very different sector.
Yeah, Big Bear uses composite AI to run digital twins of supply chains. So, if a geopolitical event closes a major shipping lane, their software simulates thousands of alternative routing scenarios for the Department of Defense in seconds, rerouting logistics before the bottleneck ever physically manifests.
Which is incredibly valuable niche technology.
Extremely valuable.
Yeah.
But you sacrificed both of these highly specialized, innovative companies to chase a historic, once-in-a-generation monster in SPCX.
You did.
And here is where I am going to defend your move, actually.
Right.
Because I look at this aggressive growth play, and I see a deeply compelling strategic consolidation.
Really? You don't think it's too aggressive?
No, listen, you looked at the board and realized that holding niche players doesn't make sense when the apex asset is finally available.
Yeah.
I mean, if you want to be exposed to the AI sector, why hold a smaller player like BigBear.ai when the XAI component of the SPCX merger likely eclipses the upside of almost every other AI play on the market?
Okay, I see your point, but
I mean, think about it. Big Bear is analyzing supply chains on Earth. XAI is likely optimizing the logistics for an off-world colony using a proprietary, unhackable satellite network. You consolidated your capital to back the undeniable monopoly of the future.
see, but that narrative right there, the undeniable monopoly of the future, that is precisely the psychological mechanism that investment banks rely on to artificially inflate day one IPO pricing.
Oh, here we go.
No, seriously, we need to dissect the actual mechanics of an initial public offering to understand the extreme danger of what you just executed by buying in today.
You're talking about how underwriters deliberately construct the pop on day one.
I am. Let's look at how the sausage is made. When a company goes public, the underwriters, the major investment banks managing the IPO, they take the company on a roadshow.
Right, pitching to the big guys.
Exactly. They pitch to massive institutional investors, hedge funds, pension funds, and the banks price the initial shares specifically for those institutions. But here's the critical mechanism. Underwriters deliberately underprice the stock slightly compared to the actual demand they were seeing.
Okay, they underprice it on purpose.
Yes. They do this to guarantee that when the stock hits the open retail market on Friday morning, which is today, the pent-up retail demand will wildly bid up the price.
Creating that massive day one surge that dominates the financial news cycle, it creates a self-fulfilling hype loop.
Exactly.
Retail investors see the price surging in the first hour of trading, FOMO kicks in, and they buy in at a massive premium.
Right, because the institutions who bought the pre-IPO allocation got in at a specific lower price. When you, the retail investor, buy the stock on the open market today, you are buying at an astronomically inflated premium driven by the exact monopoly of the future narrative you were just describing.
Oh, okay.
Yeah. You traded established quantities, Replimune and Big Bear, to buy into the absolute peak of a manufactured hype cycle.
But let's define what established quantity means mechanically. Replimune and Big Bear are volatile, yes, but they have a public trading history. They have quarterly earnings reports that algorithms and analysts have scrutinized for years.
True.
They have known institutional support levels. Their price somewhat reflects their actual present-day fundamental value based on revenue, cash on hand, and projected growth.
And SPCX has none of that public market price discovery yet. The fundamentals of SpaceX and xAI's technology might be stellar, but the fundamentals of market mechanics remain undefeated.
Which means,
Historically, mega IPOs experience a severe correction roughly 30 to 90 days after the debut.
the lockup period ending.
Exactly. The initial retail frenzy burns out, and the institutional investors, the ones who got in cheap, they decide to lock in their initial profits by selling off a massive portion of their shares.
And when millions of institutional shares suddenly flood the market, the supply overwhelms the retail demand and the stock price craters.
It's simple supply and demand mechanics. By jumping into the deep end on day one, you are exposing your reallocated capital to massive immediate downside.
Right.
I mean, think about what happens if SPCX corrects by 20% over the next month as the lockup periods approach and the hype cools. Your entire reallocated capital drops by 20%.
While your old stocks might be having a great month.
Exactly. Meanwhile, Replimune might announce a successful Phase 2 clinical trial tomorrow and pop 40%. BigBear.ai might land a massive new Department of Defense contract and surge.
Okay, I hear the risk mechanics, and I agree that buying an IPO on day one is essentially jumping onto a moving train.
Yeah.
You are going to take some impact damage. But let me push back on the timeline here.
Okay, go ahead.
If you are playing the long game, let's say you have a 5 to 10 year time horizon for this portfolio move, does that day one entry price really matter?
Well, it depends.
I mean, if the mechanics of this combined entity genuinely dominate global telecommunications, space infrastructure, and artificial intelligence for the next decade, won't today's inflated price look like an absolute bargain by 2035?
You're relying on the Amazon in 1999 defense.
Yes, which worked.
While the logic says that if you bought Amazon at its absolute peak during the dot-com bubble and simply held it for 20 years, you eventually made a fortune. But we have to look at the psychological mechanics of holding through a drawdown.
It's tough.
It is. You would have had to survive a 90% drawdown in your portfolio value in the early 2000s without panic selling. When you liquidate your entire microcap safety net to buy a single megacap stock, can you actually stomach watching your portfolio slide backward for 2 straight years if the market decides the xAI merger synergies will take a decade to monetize instead of a few quarters?
Yeah, it's incredibly easy to be a long-term visionary when the chart is green.
Right.
It is agonizingly difficult when you've just sold off a biotech firm that cures tumors to watch your new space stock trade sideways for 18 months because the launch costs were higher than Wall Street projected.
Which brings us to a mathematical principle that makes your trades even more dangerous, honestly. The law of large numbers.
Yes, lay it on me.
There is a structural shift happening where retail capital believes you either own the absolute biggest monopoly in a sector or you shouldn't be in the sector at all. You abandon the microcap space to own a multi-trillion-dollar company.
Because a trillion-dollar company feels safer. It feels inevitable.
It feels inevitable, but mathematically, the ceiling for growth is drastically lower. Let's look at the actual numbers. If you invest in a $1 billion company like a mid-cap biotech, and they hit the right product-market fit, or in Replimune's case, get FDA approval for a blockbuster cancer therapy.
They explode.
Right. That company can become a $10 billion company relatively quickly. That is a 10x return on your investment. The capital required to add $9 billion in value to a market is very achievable.
But for a $3 trillion company like SCCX to deliver that same 10x return,
It has to become a $30 trillion company.
which is insane to even think about.
Exactly.
Huh.
To simply double in size from $3 trillion to $6 trillion, STCX has to generate $3 trillion in new fundamental value. That is the entire gross domestic product of the United Kingdom or France.
Wow.
The sheer gravity of the capital required to move the needle on a mega-cap stock is astronomical. The law of large numbers dictates that as a company's scale grows, its percentage growth rate must inevitably slow down because it simply runs out of addressable market to conquer.
So by selling Replimune and Big Bear, you might have fundamentally lowered your mathematical ceiling for massive gains, even though psychologically it feels like you just bought into the most aggressive growth story on the planet.
Exactly. A lot of the future growth of SpaceX and xAI has already been priced into that day one valuation by the underwriters.
Which is a tough pill to swallow.
It's the paradox of the mega-cap IPO. You are paying a premium for future perfection. If SPCX executes its business plan flawlessly, the stock might just hold its current valuation because flawless execution was already expected.
And if they stumble?
If they stumble even slightly, if a Starship launch fails or XAI faces a regulatory hurdle, the valuation corrects violently. With microcaps, the expectation of failure is priced in, so any surprise success generates massive upside.
You know, this clash is what makes dissecting your portfolio moves so fascinating. On one hand, you have the fearless pursuit of what genuinely might be the most important technological and corporate entity of the 21st century.
True.
You looked at the board, saw the mechanics of the SpaceX and XAI merger, and decided you wanted the strongest, most structurally integrated piece in the game, liquidating whatever you had to acquire it.
And on the other hand, we have the brutal reality of IPO market mechanics, trading known volatility and high-growth mathematical ceilings for massive, highly priced uncertainty. It perfectly encapsulates the modern investor's dilemma. Do you hunt for the asymmetric hidden gems in the microcap space, relying on the science of viral lysis and composite AI, or do you surrender to the sheer capital gravity of the megacaps?
As we wrap this up, that really is the core tension we've been unpacking today. The historic, multi-trillion-dollar awe of the SPCX debut colliding directly with the incredibly high-wire act of dumping established assets like you did with REPL and BBAI to chase that manufactured day-one IPO hype cycle.
It takes a tremendous amount of conviction to execute a portfolio sweep like that. Whether this reallocation goes down in your personal ledger as a stroke of visionary genius or a hype-fueled misstep.
Only time will tell.
Right. Only the mechanics of the market over the coming quarters will determine that, but your trades are a flawless reflection of the high-stakes environment we are analyzing right now.
They really are. It's a bold play that forces us to look hard at how liquidity moves through this ecosystem. So I think that's a great place to leave it.
Well, it actually leaves me with one final thought to mull over, not just for you, but for anyone watching the NASDAQ today.
Okay, what is it?
When a multi-trillion-dollar behemoth physically drains the capital from the market, like a sponge in a bucket, does it permanently starve the liquidity pool for the smaller, highly innovative companies trying to cure cancer and optimize global logistics?
Right.
Or will this megacap hype inevitably fracture, sending a massive flood of capital flowing right back down into the ocean of underdogs?
Are we witnessing a permanent consolidation of wealth into single mega entities, or just a temporary tide that will eventually roll back out? We will see where the market's gravity takes us next.